Nolan, so good to see you. We are taking a look at 76 years of headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500 has endured decades of events and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio. And I'd like to start with this chart. So what stands out to you here about how the market responds to global events?
Yeah, thanks, Erin. And this is a very nice chart because it shows us a long time of huge global events and what the market's done in response to it. I like looking at charts like this because it shows us that the general trend line is in an upward direction, but you can very clearly identify, and maybe we'll talk about how you can have bad decade-long periods or decade and a half long periods during, some events. So, during times like that, it's important for added protections. We'll talk about some of those risks today throughout that discussion, but general
Mhm.
upward trend, it's just how you want to engage in that upward trend and how much
Right.
risk you're willing to take to get it.
It's easy to see when you zoom out that, staying the course, staying invested is often the best advice. But if I am stressed out about how I'm invested, when is the right time to make changes to your portfolio?
Yeah, most times the best time to make changes to your portfolio is when you are making money or when you're profitable or when there are extra funds in the account to give you added flexibility with certain things. Those are usually the best times. The worst times usually is after an event has already occurred. If we're talking wartime situation like we've recently gone through, the worst time probably was just after the market dropped out from everything. You would have wanted to protect against oil shocks and crises at the moment of impact, not 1 or 2 months later. So,
Mhm.
you're trying not to respond at negative times. You're trying to do so proactively, sell when you've made gains, rebalance on a regular basis.
Mhm. And how does that answer change for someone who is recently retired or nearing retirement?
Yeah, those folks may want to protect their money from market-based fluctuation and market-based investments a little bit more or a little bit longer before their needed event of income. So if you're
Mhm.
needing income from your portfolio, you may not be capable of withstanding a 20 or 30% loss in your portfolio. So understanding that staying the course and staying invested does have good merit to it, but you do not need to engage in all of the downside that the market gives you the chance to engage in. So taking some of that risk off the table is important as you near retirement.
Right. I'm really glad you brought that up because people who are retiring into a down market, it presents a unique challenge known as sequence risk. Can you explain that risk, please?
Sure. Sequence risk is the risk essentially that market returns are negative or bad during the early years of retirement. And what we've demonstrated in this chart is a 4% rate of return over a 15-year period. Maybe you've gone through like a recession or two. Like to consider this maybe the years 2000 through 2015 to give you rates of return like this. So all we've done here is just flip the rate of return. So in the early years on the left, you've gotten a positive rate of return. Early years on the right, you've gotten a negative rate of return. You can see at the end of a 15-year retirement how there's still a lot of money in the pot in situation one. But in number two, even with the same average return, there's much, much less money. You are drawing on the account at the same time that you're, sustaining losses. And
Right.
that makes the losses worse. Usually when losses are worse, people aren't prone to getting more aggressive to recover those. So you end up kind of digging into a hole a little bit
Mhm.
behaviorally.
Of course, we have no control over what the market is doing when we retire. So, how do you guard against sequence risk?
Yeah, there's a good visual that we have here for sequence risk and ways to guard against it. So you can guard against sequence risk really with taking money out of the growth bucket over on the right hand side, where things are more susceptible to volatility and more susceptible to going up and down, and then figuring out how it may be appropriate to put place some of your investable assets into the middle and left buckets, checking, savings, managed money, banking products. That's in the left bucket. And then in the middle are your more stable investments beyond growth stocks on the right-hand side. Stable investments being like more real estate, which are income driven, or dividend bearing investments where the value doesn't go up and down too much. These are all options to mitigate that sequence risk. So as you're approaching retirement, it's just good to look at these, learn more about them. They're not appropriate for everybody. Not everyone uses each one. It's just you need to know which ones are available and figure out which one works best for you.
Right, absolutely. There's so much that we can control, so much that we can't control. So having that plan in place before you retire is so important. Nolan, if somebody would like to sit down with you and create that plan, what's the best way to reach you?
Sure. They can call 616-301-2581 or our website, which is cornerstone-rp.com. And there's a contact us box at the bottom of the homepage.
Great. Nolan, thank you.
Thanks, Erin.